All right, let's talk about tax year 2025. You've got this great new above-the-line deduction for overtime, but here's the catch. The IRS hasn't updated the Form W-2 to actually report it. So how on earth are you supposed to substantiate it? Well, the answer is an IRS Notice 2025-69, and that's exactly what we're going to break down right now.
So here's our game plan. We'll start with the core problem this new law creates for us in 2025. We'll look at the background, specifically the new Section 225. Then we'll dive into the nitty-gritty of how to calculate the deduction using the IRS's own methods. We'll walk through the official examples, cover the critical practice pitfalls, and wrap it all up with the key takeaways for your firm.
Okay, so the problem is actually pretty straightforward. OBBA, the One Big Beautiful Bill Act, created this brand new deduction for qualified overtime, and that's a huge benefit for a lot of our wage-earning clients. But, and this is a big but, for the 2025 tax year, the form we all live and die by, the W-2, is just not going to have a separate box for this amount.
And that brings us to the million-dollar question every single one of us is asking. Without a dedicated line on the W-2, how do we properly calculate this thing? And maybe even more important, how do we substantiate it if the IRS comes knocking? Notice 2025-69 is the service's direct answer to that exact problem.
The solution the IRS has given us is really grounded in the new law itself. So to apply all this guidance correctly, we first have to get a handle on the fundamentals of the new Internal Revenue Code Section 225. This is the statutory foundation for this entire deduction. Let's really zero in on this definition of qualified overtime compensation, because the wording here is absolutely critical. It is not all overtime pay. It's specifically the premium portion, the half in time and a half, that is mandated by the Fair Labor Standards Act, or FLSA. And the reason for this is key. Congress only authorized a deduction for the federally mandated premium. Anything more generous is just a private employer benefit, and it's not part of this deduction. Now, before we get into the calculations, let's just quickly run through the high-level parameters. The maximum deduction is $12,500, or double that, $25,000 for joint filers. Watch out for the MAGI phase-out. It starts at $150,000 for most filers, $300,000 for joint returns. And this is a big one. Married taxpayers must file a joint return to claim it. And for now, this provision is set to run from 2025 through 2028. All right, now for the fun part, the mechanics. Since we don't have that W-2 box, the notice gives us specific IRS-sanctioned, reasonable methods so we can calculate the deductible amount directly from our client's payroll documents. This is literally our playbook for 2025. The notice gives us three main ways to attack this. Method A is the dream scenario. If a pay stub actually breaks out the overtime premium, you're golden. Just use that number. Method B is going to be way more common. We call it the 1/3 rule. If the pay stub just shows total time and half pay, you simply divide that total by 3. And then you've got method C. This is for situations like double time, where we have to use a specific fraction to isolate just the FLSA-mandated portion of the pay. The best way to really master these methods is just see them in action. So let's walk through the exact examples the IRS provides in Notice 2025-69. This shows us how they expect us to apply this logic in different client situations. These first two examples perfectly illustrate the two scenarios you're going to see most often. In example 1, the payroll system does the heavy lifting and identifies a $5,000 premium. Boom! That's your number. In example 2, though, the pay stub just shows a lump sum of $15,000 in total overtime. No problem. This is where we use the 1/3 rule. $15,000 divided by 3 gives us that same deductible amount of $5,000. So what happens if an employer pays more than the FLSA requires, like double time? The key principle is that the deduction is still limited to the FLSA required amount. So in example 3, the stub shows a $10,000 premium for double time, while the FLSA only requires a 0.5 premium, but double time is a 1.0 premium. So we just divide that 10 grand by 2 to find the $5,000 FLSA equivalent. In example 4, the total double time pay is $20,000. To isolate the deductible part, we have to divide that total by 4. That gets us right back to that same $5,000 deductible amount. The notice also walks through a couple of special cases, just to show how universal these principles are. Take example 5. It's about a law enforcement officer who's paid under the special work period rules. You might think that changes things, but it doesn't. The calculation principle is exactly the same. The officer gets $15,000 in total overtime pay, so we just apply our handy 1/3 rule and land at a $5,000 deduction.
Example 6 tackles compensatory time for public sector folks. Here the key is the timing. The deduction isn't triggered when the comp time is earned, but when it's paid out as cash wages. In this situation, the individual was paid $4,500 for comp time they used in 2025. Applying the 1/3 rule, the deductible amount is $1,500.
Okay, so we've got the rules, we have the examples. Let's pivot now to what this all means for our practices. How do we actually operationalize this guidance, and what are the traps we really need to watch out for?
First, documentation is everything. The W-2 is not going to be enough. We need our clients' pay stubs or their annual payroll reports. Second, and this is the biggest pitfall, we have to confirm the overtime is required by the FLSA. If it's just voluntary, contractual, or based on a state law that's more generous, it doesn't qualify. This means we have to be proactive. We need to ask every wage-earning client about overtime and what documents they have. A simple idea, add a line to your organizer that says, "Did you receive overtime pay? If so, please provide your final 2025 pay stub."
So, knowing the pitfalls, let's distill all of this down into 3 essential takeaways that you can implement in your practice for this upcoming filing season.
Takeaway number 1. For 2025, you cannot rely on the Form W-2 for this deduction. Period. You have to look past the standard info returns and go straight to the source payroll documents.
Takeaway number 2. The notice is our safe harbor here. You need to rely on client pay stubs and use those reasonable methods we talked about, the 1/3 rule or the fractional method. This is the official IRS-approved approach.
And finally, takeaway number 3. Diligence is absolutely key. Not all pay that's labeled overtime is actually qualified overtime compensation. You have to confirm that the pay is mandated by the Fair Labor Standards Act. Getting this right is what protects both you and your client.
So what does this mean in practical terms? It means you need to update your internal processes, and you need to do it now. Review your engagement letters, your client organizers, and your 2025 tax season checklists. Make sure you are incorporating questions and document requests specifically for this new deduction, all based on these new rules from Notice 2025-69.
And that leaves us with one last thing to think about. We now have the technical guidance from the IRS. The challenge is shifting from understanding the rules to implementing them. So the real question is, what process will you put in place to make sure you systematically identify, calculate, and properly document this valuable deduction for every single eligible client?